Has the market's remarkable rally finally met its biggest test of the year? This week brings the Federal Reserve, four of the world's largest technology companies reporting earnings, fresh inflation and GDP data, and continued geopolitical tensions. By Friday, investors could have a very different outlook for the second half of 2026. Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, July 27th, 2026. After months of optimism, last week reminded investors that even strong markets pause to reassess. Higher treasury yields, rising oil prices, geopolitical uncertainty, and mixed reactions to corporate earnings combined to produce the market's weakest week in over a month. The important lesson is this: markets don't move because of today's headlines. They move because expectations about tomorrow are constantly changing. Let's break down what happened, why it matters, and what I'll be watching this week. Last week, investors stepped back from record highs. The Nasdaq fell more than 2% for the week as technology stocks came under pressure, while the S&P 500 also finished lower after posting new highs earlier this month. Interestingly, the weakness wasn't driven by one disappointing earnings report. It reflected a broader shift in investor psychology. Wall Street has spent much of 2026 rewarding companies for investing aggressively in artificial intelligence. Now, investors are asking a different question. When will those investments begin producing meaningful profits? That transition from excitement to accountability often creates volatility. At the same time, Treasury yields moved higher while oil prices surged during the week, adding new uncertainty to inflation expectations. Those developments set the stage for what could become one of the most consequential weeks of the summer. This week revolves around three interconnected stories. First, the Federal Reserve. Chair Kevin Warsh presides over his latest Federal Open Market Committee, and while most economists still expect interest rates to remain unchanged, the conversation has become considerably more complicated. Recent increases in energy prices, resilient economic growth, and stubborn inflation have reduced confidence that the Fed will begin easing monetary policy as quickly as markets previously anticipated. Investors won't simply be listening for whether rates change. They'll be listening for how Chairman Warsh describes the balance between inflation and economic growth. His words could influence markets far more than policy decision itself. Second, earnings season reaches its most important week. Several of the world's most influential companies report earnings over the next few days. Tuesday brings Boeing and Visa. Wednesday features Microsoft and Meta. Thursday brings Apple and Amazon. Friday closes with energy giants Chevron and ExxonMobil. Notice the pattern. These companies represent nearly every major part of the American economy: technology, consumer spending, industrial production, financial transaction, and energy. Together, they provide an extraordinary snapshot of where the economy stands today and where corporate leaders believe it is heading. More importantly, investors will be closely watching what these companies say about artificial intelligence spending. The market no longer wants to hear only about investment. It wants evidence that investment is increasing or creating profitable growth. Third, economic data. This week delivers one of the busiest economic calendars of the year. We'll receive advanced second quarter GDP, consumer confidence, JOLTS job openings, the core PCE inflation index, personal income and spending, and Friday's employment report. Together, these reports will answer one critical question: is the economy slowing just enough to reduce inflation without slowing enough to threaten corporate earnings? That remains the Federal Reserve's challenge. Markets are also watching developments far beyond our borders. Although oil prices pulled back slightly into Friday's close, tensions involving Iran and shipping through the Strait of Hormuz remain elevated. This matters because roughly one-fifth of the world's oil supply passes through that narrow waterway. When investors become concerned about disruptions, energy prices often rise long before any actual supply shortage develops. Higher energy prices increase transportation costs. Transportation raises manufacturing costs. Manufacturing influences consumer prices. Consumer prices affect inflation, and inflation influences Federal Reserve policy. That's what economists call the transmission mechanism. Understanding these connections help explain why geopolitical events can influence your investment portfolio even when they occur thousands of miles away. So what should long-term investors do? If you have a higher risk tolerance, periods like this often create opportunities to evaluate high-quality companies that experience short-term price declines despite maintaining strong long-term fundamentals. Stay diversified. Stay disciplined. Focus on business quality rather than daily headlines. If you have a lower risk tolerance, this is exactly why a well-designed financial plan includes appropriate diversification, liquidity, and realistic expectations. Volatility is uncomfortable. It's not unusual. Remember, stabilization is not normalization. Inflation has improved significantly from its peak, but the economy has not completely returned to the low inflation, low interest rate environment investors became accustomed to during the previous decade. And perhaps the most important reminder this week, market expectations are not actual economic conditions. Markets react to what investors believe will happen. Financial plans are built around what families need to accomplish over many years. Those are two very different things. As we head into the week, I'm watching three things. First, whether Chairman Warsh's comments change expectations for the path of interest rates. Second, whether Microsoft, Meta, Apple, and Amazon demonstrate that massive investments in artificial intelligence are beginning to translate into profitable growth. And third, whether GDP, core PCE inflation, and Friday's employment report confirm that the economy continues moving toward a sustainable balance between growth and inflation. Those three developments are likely to determine not only how markets finish July, but how investors begin thinking about the remainder of 2026. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.